All right, everybody, welcome to the Sherman Show. This is our first COVID Sherman Show in a new COVID world. You can see we're practicing social distancing, physical distancing. We're also practicing face mask, but I'm going to take it off just so we're all friends here, and we know that we know you've been quarantined, so
yes,
we feel very good about that.
I'm deep in COVID paranoia.
Yeah, so welcome to the Sherman Show. We're doing this in video format today for our YouTube channel as well. So for those of you listening to this, you can go to the YouTube channel. It's youtube.com/DoubleLine, capital, all one word. You can catch this video there. So today we have none other than our returning guest, Danielle DiMartino Booth. You know her well as a former Fed official. You've also, have Quill Intelligence.
I do.
You continue to just crush it in interviews, so that's why we had to have you back. And I hear now that you've launched a new medium platform called Valuetainment Economics.
Valuetainment Economics. We're going to call it VTE. We've got to shorten it up a little bit, but
and it wouldn't be finance without an acronym, right?
It wouldn't. Of course not. No, everything needs an acronym. We might even put a dollar symbol in front of it, to make it a ticker.
Okay.
I did an interview with Patrick Bet-David, who he interviews quite a few controversial people, and also he just interviewed W, our former president. So full spectrum of guests. And the only reason I did the interview was because they have a studio in Dallas. And long story short, it went completely viral. He dug deep. He really pulled information out of me I didn't even know was there. He was just an extraordinarily good interviewer. And 20 plus million hits worldwide later, they decided that I should launch my own show. So this is pretty exciting.
It was a great interview too. I mean, I love the intro to just the sound bites of the things that you've said. I mean,
tantamount to an act of war.
Right, on top of that, it was almost like it was scripted. So that's what I'm saying. It was such good content. So
and now we have China stepping away. Right. Believe it or not, and they're not buying anything. Right. Wow.
Yeah. So. And I think you're the one that called it too, saying that there was a pandemic clause in there, shockingly. So
very unusual. Yes.
One thing I forgot to do is introduce my co-host, Sam Lau.
Hey.
Okay, there we know. Now
Sam
you'll know he's here.
Here we are.
Yeah, now we know he's here. So Danielle, before we jump in, we're giving market updates to our clientele, just given how volatile things have been.
Sure.
So Sam, do you want to kick us off with the market update since the last time we chatted?
Yeah, so we'll start it off with the quarter to dates. S&P 500 up just about 2% on the quarter through July 9th. The Barclays aggregate up 70 basis points. Gold pretty much flat. Let's just call it 20 basis points. But what's interesting is the red metal, Dr. Copper, is up about 5% quarter to date. So, Jeff, this is one of the indicators that we take a look at, the copper gold ratio. So that kind of, is hinting.
Yeah, I mean, that kind of signals to us that maybe yield should be a little bit higher here, but we know we have Fed manipulation. That's another reason we have Danielle here to chime in. But yeah, that is definitely an interesting relationship.
Well, I mean, if you consider that COVID is running rampant in South America, I mean, that alone is such a massive pull on that one red metal.
Right.
That's right.
And that's from a supply side, right? Constraining the supply there, right?
Correct.
So, okay, continue on.
Yeah, and then when we move over to WTI crude oil futures, that's up about 1% now. Still down 35% on the year, however.
But massively off that negative $40 per barrel price.
Same thing with copper. Copper's had a nice little rally back, and it actually put itself about positive on a year-to-date basis. Moving the sovereigns on the 10-year yield front, if we look at treasuries, we're looking at about 60 basis points through last night. 10-year boons down about 45 basis points, or negative. I keep saying down because I see that negative sign in front, but negative 45 basis points on the boon. And JGBs, they crept up positive, so they have a plus handle in front of this 2 basis points.
Go Kuroda.
Yeah.
So, that's really amazing how much moves we have there.
Kuroda-san got us that yield curve control. Maybe he's losing control of that yield curve from it going all the way from 0 to 2 basis points, right?
Well, I guess
I still scratch my head. I'm like, people are like, the Fed's going to launch yield curve control. I'm like, what are they going to control exactly?
Yeah. Well, let's hold that thought.
Let's
hold that thought.
We got to ask you if Powell's is taking notes on these things, but... in terms of spreads, moving over to credit on investment-grade cash bonds here. On an OAS basis, we have 145 basis points.
Let's also point out, yesterday was a seminal day in the corporate bond market on the investment-grade corporate index on a yield-to-call basis, a yield-to-worst as they call it.
Yep. Yeah.
Broke the 2 handle.
2%.
Oh, it went inside of 2%. So you get paid less than 2% to take corporate credit risk in droves with new size, with more duration
and
than
these
ever.
poor CFOs can't even buy back their shares.
I know, it's sad.
It's delicious.
Yes.
Yeah, and this is on the backdrop of the massive run-up in actual net, gross and net issuance over the last
gosh.
10
I
years,
mean,
right? So-
that's a huge subject for us to discuss because the corporate sector has breached the level.
yeah.
Stay tuned for the
Have
left.
to see if some of
dot.
these zombies, some of these zombies can continue marching around. So, over in high yield land, it's 620 basis points on the OAS and EM at 375 basis points. But it's been pretty much quiet across
That
those three
375
fronts.
is key to us. That's kind of been the average level for the last couple of months. 350 has been hard to breach. 400 we haven't really widened out to there, but we have dialed down our risk a little bit on EM as of late. As
yeah.
you mentioned, the COVID, the fiscal wherewithal to be able to respond, and just the explosion of the virus in specifically Latin America.
Yeah, and they've got some debt to refinance.
Yes, yeah.
In
So
a big
that's
way.
that's an area that we have been trimming risk, especially as of late. Again, going into the quarter, we trimmed a little bit more there too. So
Yeah. So that's it for the market. We got some economics, stuff that we can talk about, but I think we're going to hit into this with Danielle. But maybe I can kind of kick it off by making a note here that the Federal Reserve's balance sheet went under $7 trillion last night. It's 6.9 trillion now. So
They're so conservative.
that's great.
Right. I mean, is it still the swap lines that's driving it? The removal of some of those swap lines, or what is that last kind of leg
so
down?
Kind of the spread between, if you look at the Federal Reserve balance sheet and what's been on the SOMA books as well, the portfolio holdings there, that's kind of been around the 700 billion differential. That's kind of maintained still.
Can you imagine running that MBS book right now with prepayments going bananas?
Yeah.
Well, I remember that too. One of my old colleagues used to call Fannie and Freddie the biggest hedge funds in the world because they got to borrow at agency type rates and essentially lever up their book, and they were the worst risk managers ever. If you looked at the P&L and the hedges swung so much. And it was an example of again, it's kind of a quasi government job, but so it's going to be a challenge. We've been very cautious on the prepayment speeds, thinking they're going to be escalated. This is also where you have to discern how you buy the coupons in the stack too, because there's been a huge difference. Obviously, that moneyness has changed significantly. So I do also think last month is the first time we actually saw Fannie or Freddie issue a 1.5 coupon mortgage. So I know people out there are probably scratching their heads. They go to refi, they're getting 3.5%, 4% kind of
Come
quotes out
on,
there.
my 73-year-old mother is like in a Ginnie Mae fund. I mean, it's yielding nothing.
Right. Well, and you have prepayment risk. So unfortunately, if those do accelerate because of the price of those bonds, it could be challenging. So
And they're occurring in a vacuum because of the forbearance.
right.
Yeah.
So it's just, and there's no credit cycle.
Yeah. So anyway, continue on. You got anything else to give us on the econ front?
Nothing on the econ front, we'll probably get to it also, but just the disparities again between what we're seeing in insurance claims, both on the state and now the federal level versus what we've been seeing in the non-farm payrolls.
Oh, can we talk?
Yeah,
There's
let's
stuff
start
there.
there because I think to me this is a critical piece too, and there's probably some duplicity in the accounting between the PUA, I call it PUA, the Pandemic Unemployment Assistance, and the state claims.
I'm gonna push back because
Okay.
I spent an hour yesterday on the Department of Labor's website.
Sure.
They have a grid, and there is definitely double counting when it comes to applying
initial claims, right?
Initial
Right, but not
claims.
continuing, right?
And you're seeing massive, by the way, revisions in back weeks to the PUA claims.
Right. So that's why you see some of these volatile numbers in the initial PUA claims.
Correct.
Because they could have been filed 3 or 4 weeks ago, but they're having trouble getting through the
Once
system.
you're in a pool, once you've been approved and you are a claimant and collecting unemployment insurance, you cannot have 2 feet in 2 different pools. You're knocked out of one if you're getting the other.
Okay.
So that 32.9 million number is solid.
That is solid. Okay, that's what we've been contending. We get a lot of pushback in there.
Well, there's a ton of pushback because it's
not a bullish story, right?
Well, no, it's 20.7% of the 159 million strong U.S. workforce as of the size of the June workforce.
Right, and actually, what I kind of backed into, given that we have continuing claims now at 18 million. That's
And
the
Jim
traditional.
Bianco came up with an even higher number. Anyways.
Yeah, he's been throwing out about 34, 35 million, I think, on unemployment is what I heard from him on his webcast yesterday. But also, if you look at that number, that 18 million just on the traditional claims, let's not
Right.
count the PUA. I still like to say PUA, I think.
PUA.
It's kind of like Tua, that quarterback out
I
there.
know, it makes you want to giggle.
Yeah, a little
Did
bit.
he say poo?
Yeah. See, I got to emphasize the speech.
I have 3 boys. Come on.
Okay,
Anyways.
fair enough. But anyway, the 18 million number is consistent with the payroll data, the non-farms jobs roll of adding that, because if you go to peak claims, and you go to peak claims, it was about 24 million on continuing. So that is consistent in there. So I don't find that there's these large inconsistencies in the data set. I've heard people portray that there is double counting these programs, but it sure doesn't seem that way. And these are critical to the consumer.
Oh gosh, I mean, you could drive a Mack truck between 11.1% and 20.7%, or use Jim Bianco's bigger number. It's the disparity, but you're right. If you back into the number, BLS said, the Bureau of Labor Statistics said that there was only a 1 million differential this time, as opposed to May's, where there was a 5 million differential that they couldn't account for these PPP, the people who are on payrolls but not working, and so they were having
and are they truly unemployed? They think they're employed.
Misclassification errors and the whole thing.
And there's a sampling error too in the NFP, but the response rate has been diminished significantly. It's like low 60s, where it's typically in the 80s.
But if you look at continuing claims and then you kick in that extra million or so, you get to 11.1%.
Yeah.
So there's consistency. It's just PUA's nowhere at the BLS. It's like they've got the doors barred. Mm-hmm. And I think that and because it's an 18... Is it 18 million alone?
It's 18 million alone. That was the number that came out yesterday. And then the PUA is close to 13, I think.
Around 13, 14.
13, yeah. So, because I mean, that page 4 is everybody's new best friend.
Right.
Well,
I like that because it's not survey, it's factual data, right? And we know it. We knew there's been a backlog, but we're 3 months in now, right?
Yeah.
So that backlog is clearing itself up. That data keeps printing every week. You get to look at it, and it's barely budging. Right.
And you know what I also think is fascinating? I mean, it's a rounding error number, but it was like 1,800 or so people who were getting their employers filing on their behalf because they've cut their hours or their income. So they get a supplementary type of unemployment insurance. Okay. There's a little line item down there. It's been it's 327,000 or so. It's part of that page 4.
Okay.
But what you're hearing, and I'm looking at downtown Los Angeles with the Deloitte and Touches of the world, with all these big consultants. One of our interns right now at Quill Intelligence, he's got a job at Oliver Wyman, but they've put him on hold until January. You can tell with this kick up in claims attached to falling income, where the white collar
is starting to get into there, right? Yeah.
And then you've got Wells Fargo that I think will open the floodgates with bank earnings coming. I think you just needed that first big bank to push through big layoffs,
right?
And now you're going to see it.
It's accepted, right? Everybody gets to
now
do
everybody's going to do it.
Yeah. So let's talk about the PUA. My understanding is that one goes to the end of the year. So those claims
December
are protected
31st.
now.
Yes.
Now, what does expire is PPP, right? The Paycheck Protection Program, the ability to go to those programs, and then again, there's no more assistance in there. The loans are supposedly forgiven if you keep your people on. That goes away, right? Then we also have the $600 supplement, which is huge. I know you've been writing about this too.
My gosh.
And so let's talk about the importance of that, because I saw some chart yesterday, I think it was from one of the big banks, and what they put out was talking about watching income increase into a recession. We've never seen that. When the recession starts, and it usually takes time if there is that transfer
I saw that chart running around, and it's a huge, I mean, again, that's why the credit cycle's frozen.
Yeah.
We can't see what's not happening.
Right.
We can't see people getting evicted because they're not getting evicted. We're not seeing cars getting repossessed because... So it's this bizarre dynamic where you've got subprime behaving very well at the onset of a recession.
Yeah. Do you know what was one? So in the structured products area, when you look at all these kind of collateralized stuff out there, so it can be autos, student loans, consumer loans. One of the best performers and quickest to rebound the ABS market was actually consumer-based product. And it wasn't just because of TALF eligibility,
right?
But it's just that people are looking at these short-term data sets and saying, okay, well, month over month, look at this increase in spending. There's no collapse in spending. Well, it's because we printed $2 trillion from Congress to put in people's pockets.
And you have to bear in mind the nature of the consumption of the recipients.
Yes.
They're by nature not savers. Right. They have been living paycheck to paycheck for as long as they've been working, so they're accustomed to spending every dime. There's no savings account with this cohort of income earners. Yeah. They only have checking accounts and they blow through it all.
Yeah.
So spending has kicked up.
Yeah, and we also we had a guest on earlier this week, and we'll publish this next week just to keep our schedule consistent. But he was talking about, he's a big proponent of putting it in the lower income wages because that is at least stimulative to the economy because they are the spenders. Exactly the point you're making there. And you look at this and you look at the income increase and you look at the spending. I mean, look, I think we could actually get to the point where is it the BLS that determines the recession? NBER, right?
NBER, yeah.
Right. So the NBER could actually say we're out of the recession at the end of June. Right.
Well,
it could, I'm just saying when you
yes,
look at some of the bosses,
yes,
now we don't
yes.
believe that,
Right.
And we believe there could be another shoe to drop. Where is it a double dip, or is it really we never really got through here?
I think we're going to start to see if you studied the weeds of the producer price index.
Data came out today too. It was negative again. It was pretty bad. Except when you pulled out trade was the big piece of it that caused negativity. However,
but even if you break it down across wholesale, retail, and manufacturing PPI. Margins are getting crushed.
Right.
I think we're going to start to see it in the regional Fed surveys that the V is going to be shallower.
Right.
The second side of the V is going to be shallower as we veer into W.
Yeah, right.
So,
I think that
so it's the
seems
industrial
right.
production input to MBER that
Yeah,
I'm referring
and you mentioned Jim Bianco. I just give him credit for what he's pointing out yesterday. He was looking at Shake Shack actually, and he was showing how their earnings had collapsed. But also they increased prices across the board by about 11% because they gave their workers about a 10% raise. So they were helping offset that. So he was saying, watch out for things like this because wages obviously drive inflation. We know the Phillips, all that stuff. But also you can't claw back wages typically, right? Once people start paying that level, that becomes the barometer. So he was saying to watch that. So I found that to be interesting too.
Margins are... margins are getting it in all directions.
So let's talk about earnings too, right? So have you in your career ever seen Wall Street say, just ignore this? We're not going to look at the 12 months. We're going to look at 24 months forward earnings, or let's look at 2022 earnings. Let's trade off those multiples, which by the way are still high.
Right.
Yeah, very high. But what do you think about the earnings season coming in? Because this is where we're going to finally start to see it.
Well, I think that I think that we're going to get less clarity than we think we're going to get because of the reclosing. I think that companies that don't want to frighten shareholders too badly, that used COVID as an excuse for pulling guidance, are going to use the revamping and reclosing as an excuse to push it out a quarter.
Makes sense, though. I mean,
they're going to be like, well, we still don't have any guidance because. I mean,
that's actually fair, though. They really don't have guidance, right?
They don't have guidance because all of the bullish narratives about fatalities, I'm sorry, but they're not coming to pass.
Right. Your home state just had a new record 3 days in a row with fatalities.
Absolutely.
A new record for 3 consecutive days. We haven't had the Friday data, but I mean, here in California, this county, we're leading the country in cases.
I think it was 120. 20-something in California.
And here we are not wearing masks, Danielle.
We are far apart, and we're paranoid. I've been sheltered in place since February.
Yeah. I have too, but Sam is definitely keeping the trend here.
I was paranoid before the crisis, Danielle. So this is me during it.
There's the old quote that says
therapy is extra.
Yeah. Well, there's the old quote that said just because you're paranoid doesn't mean they're not after you. Right? Yeah. So anyway, so looking at earnings and how that unfolds, how do you think about it for the second half of the year? I mean, there is so much uncertainty, and now we're in the most populous states where we're seeing these cases rise.
That's exactly my point.
By definition, of the biggest drivers of U.S. GDP and consumption.
Exactly. I mean, you're talking about California, Texas, Florida. I mean,
those are the top 4 states in population. New York's the other one, right? But they already had their wave.
Right. Yes, but they've also closed their doors.
Yeah, right.
And the city of New York, I watched the New York ISM really closely because it's 98.7% services.
Okay.
So there's like an eyedropper full of manufacturing in that particular. And by the way, Manhattan's 8% of U.S. GDP. But it is reliant on tourists.
Correct.
You have to bring the tourists back, and they've just closed the borders.
Right. You can't go there. I can't go there. It's 14-day quarantine. No. The only place that was doing that before was Hawaii. Yeah. I know, but now, which is obviously a tourism-driven place. But
it's with good reason. I mean,
it's an island. It's a lot different than, I guess you could argue Manhattan's an island, but
and
still.
And you cannot make young people rational. It's impossible. I mean, the frontal lobe of a 20-year-old guy is just not, it's non-existent. Yeah. So you can't make
Some say a 40-year-old guy too as well, but anyway.
Okay, so that's, okay, okay, you said it. But they're not mature enough to understand the dangers of being in a bar.
They're driven by different things.
Yeah.
So, reopening them is just, look, there was that one guy in Seoul who hit 5 nightclubs in one night and infected like 132 people. So that's going to be problematic for places like New York, that rely on tourism, that rely on commuting. I mean, we can talk about commercial real estate in a little while, because there's a big red flashing light. But then you pull back into what you're talking about, reclosing.
Right.
You got the 4 out of the 5 most populous states.
No, it's really scary.
I mean, like Illinois is like the only standout. Great, wonderful.
Yeah. And at least that's the time they actually go outdoors now too, right? Because you only get like 3 months a year in Illinois that you can actually go outside.
And you can't even, I mean, it's 102 degrees in Dallas.
Yeah.
People aren't dining al fresco and having a heat stroke. So, and there's no indoor dining. So it's.
And we've seen that open table data that everybody sources rolls over. It's been rolling over in Texas as well. But we didn't really even get to experience that here out in California. Right when we were about to open, all of a sudden we got hit with this wave again. And well, actually, we got a lot of riots and social injustice. So actually, let me bring that up, because I know this is something you're very strong about inequalities. And so we've heard Mr. Powell at the Fed talking about economic inequality.
Yep.
Some would say he's the culprit, or he amongst his colleagues are culprits of that. How do you think this whole thing is playing out in terms of economic inequality today? And can we solve it through these programs right now? This is supposed to be a transitory program of these unemployment benefits, right? So maybe you can expand some of those ideas you've been writing on.
So I think it comes down to the great, big, huge ideas of a debt jubilee and reserve currency status. Because if you push the inequality divide too far, you're going to end up with a sufficient mass of voters who want to bring in modern monetary theory, who want to have universal basic income, which, by the way...
Don't we already have it this year, at least?
Well, I think $600 extra a week is more than universal basic income.
It's almost $50,000 a year, or $25,000 a year.
And we've always had a social safety net. I mean, there's, as Jeffrey said in the interview yesterday to me, it's been around for 50 years. So it's just really big now. And if you back people into a corner, then they're going to vote. They're going to vote in progressive policies that are going to double our debt, and quickly. We're going to be talking about this weird concept called inflation that nobody's like, what's that?
Right.
And you're 36% of our floating treasury debt is owned by foreigners. So we need them.
Right.
And if we start to blow up our debt, these are inconceivable things, but there can be pushback. And you're seeing the South China Sea headlines. These are huge subjects to talk about, but that's what happens, I think, if we start to build our debt up to such big levels that China starts to push back, and they're building alliances with Russia and Iran and Saudi Arabia, and all of a sudden you start to go, well, God, could that Cold War turn into a hot war? But I connect the dots to the first dot is inequality, and it's what sets off this chain of events.
So I think we've seen it. It's been a long time since I've seen kind of the social unrest that we've seen. Being a native Californian, I remember riots back in the 90s. I wasn't around for the Watts riots in the 60s, but seeing the social mood change, to me, it's really predicated on the fact that there had been this pent up demand for change, but as long as the economy's kind of humming along, things are okay. Even though there's this divide in economic inequality.
We had 20 states that increased minimum wage last year, so there were little band-aids throughout the recovery. Right,
there's little small, and you get a little bone here, right? You're throwing people a bone, and again, the divide is growing and growing, but it takes one of those economic malaise periods or a shock to the system. So I'm not surprised to see the social mood change, and we saw it with voter registration. You saw the marches, and they're continuing.
And you can't not factor in the president of the United States not wearing a mask.
Right.
You can't, because that threw fuel onto the anger and divisiveness.
Yeah.
It's made the situation that much worse, because COVID has been the most divisive factor since the late 60s, since before we were born. So it's pretty amazing to see, not just economically, but for the society of the United States, what this virus has done.
Right. And it has implications not just in the, the sickness, the mortality rates, but also it has an impact on how we elect leadership too, because it looks like there is a change underway.
Right.
If you follow the polls,
Sure.
Forget the national polls. You need to focus on the key states, and but you do have Biden leading this. You have now that the Democrats are pretty much favored to win the Senate at this point. Obviously, this can change with the voting
Right.
booth, but what are those implications too?
Oh, I mean, it's again, what people don't realize is that Nancy, Chuck, and Donald didn't have some getting along moment when the debt ceiling moment came. It was extended through June of 2021.
Right.
So Uncle Sam can spend whatever he wants past the election. So if you have a sweep, in theory, you can pass monumental, century impacting legislation in this country because there's no debt ceiling.
Yeah.
It's the implications
And that's the path
are
of least
vast.
resistance at this point, right?
Absolutely. I
So
mean,
what
this
does
is
that
not.
have, like, what are those implications for like the markets too? As we think about financial markets, are they getting juiced because of that? Is it a big risk to the market? How are you thinking about quantifying
It's
that?
so hard to wrap your head around it because the fundamental drag of COVID is undeniable in bankruptcy filings. They're just a constant drumbeat in the background. I'd never heard of COEX. It's a coffee trading firm that's Miami-based that trades 3 million pounds of coffee every year, that's been in business for 40 years. But I mean, I have my BCY Go function up on my Bloomberg, and I'm like, I've never heard of that. But that's my point. There are companies going out of business that we've never heard of, and it's a constant drumbeat.
Well, there's one we heard of this week, yesterday, because the trader sent it around to me, was Brooks Brothers filing for bankruptcy because no one's buying clothes, right? With this
That's
new
right.
remote, right? Or at least of the business people. I shouldn't say no one. There's a significant reduction.
But you know what? You bring up a good point, because if you looked at the one the day before, which was the owner of Ann Taylor and Lane Bryant stores.
Yeah, L Brands, yeah. Who he's got a lot of publicity with all the Epstein stuff and everything too, right? With Western.
Yes.
But anyway, yeah.
But what people don't appreciate is that 2019 ended with non-financial debt, business debt in America at 74% of GDP. That was higher than the peak of the financial crisis, outside of recession. So I bring up Lane Bryant and Taylor because concurrent with the Chapter 11 filing that's going to affect 3,000 stores, they're liquidating and closing 1,200. So bankruptcy doesn't mean what it used to mean, because companies are so levered up that there's not enough value that they can pull out and come all the way through restructuring and maintain the same footprint, maintain the same headcount. So
it truly is a restructuring and starting over at significantly smaller size.
Right.
That's what you're implying there.
And that has macroeconomic weight that is going to offset what you're talking about, which is what can Jay Powell do if we blow the debt up and if he agrees to monetize every last penny, just outright, forthright. I mean, he's already pissed all over, excuse my French, the Federal Reserve Act of 1913.
Well, yeah,
So-
that's on our list to talk about too.
So
but-
I mean, it's not a stretch. I mean, he's going to buy equities here, and about all you need is a 10% correction, and they're going. It's in the fine print of the BlackRock agreement that equities are in there. So I mean, the structure set up. You just need the SPV, the special purpose.
Well, they found that loophole to really exploit, right? Creating the SPV.
Yeah, it's
So
like
let's
they
talk
brought in
about-
like WorldCom and Enron's former auditors, and they're like, "How do we do this?"
Yeah. Bring out the Jedi. Yeah, right. All the
It's
Jedi
called
vehicles.
off-balance
Yeah.
sheet.
So this is.
But wait, let me finish.
Please.
Real quick. I'm sorry. Let me finish. So, ballpark estimate 35% decrease GDP Q2. Because in the first half of 2020, non-financial debt increased by $2.5 trillion, we started on July 1 with a non-financial debt to GDP ratio of 96%.
And that's using first quarter GDP.
That's using second quarter GDP.
Your estimate. Okay.
Second
Okay,
quarter
got it.
GDP
Okay, got it.
through Q2 borrowing of
Okay.
$2.5 trillion.
Okay.
96% corporate debt to equity. That's what keeps Jay Powell up at night.
Yeah. Well, I remember you always telling me Jay was a markets person. He looks at the corporate market, he looks at lending as the barometer. So I guess maybe I wasn't as shocked when he brought out the idea of trying to extend money to the corporations when they're having that issue. But never did we think he was going to buy corporate bonds. Again, if there's a loophole, it's an SPV, they fund.
Because Warren Buffett needs his help.
Right, right. So, and we talked about it at the onset, 2%. Sub 2% yield in corporate bonds today. And when Jay was asked about, well, the lending's good because spreads were in. I mean, Sam's been quoting these for weeks to us, right? Spreads are at inside of pre-COVID levels, or roughly at them. Why is he buying bonds at that point? Why is he providing liquidity? And I heard the testimony in Congress. He said, well, the reason we're doing it is because we said we would. So is this a credibility thing? Is there something there? You say loosely that the market goes down 10%, they'll buy stocks. What is your take on this violation of the 1933 Federal Reserve Act?
I think they're trying to hold the whole picture together with the lowest hanging fruit that's the safest, that's not going to incur a loss. They're trying to keep the dead alive.
Remind me why those things are called below investment grade as well if they're buying? Don't they a little bit riskier? But anyway, so continue your thoughts.
Look, there was, on December the 31st, Morgan Stanley, you've seen this, said 40% of BBB rated debt
does not warrant that
was junk.
Right. Yeah.
Was effectively junk.
Right.
And I've got good friends inside the credit rating agencies who haven't slept in months. I mean, it's a 24/7 downgrade operation at these big credit rating agencies.
And not to mention also, it's not just the underlying loans and bonds, but also CLOs. I think there's like 1,000 tranches of the U.S. that are on downgrade watch currently. I mean,
oh, gosh.
Yeah, I mean, they must have the most ruthless job or the least amount of sleep out there these days.
But I think Powell's trying to hold together the seams of what BBB used to be by forcing it back into investment grade post anything downgraded post March 22nd.
Yeah.
So I think he's trying to not incur losses. He understands what he's doing is garbage. But I think he's trying to convince investors. This is a confidence game right now. He's trying to convince investors that he can keep the zombies alive if he can give them enough liquidity.
But liquidity is never a cure for solvency.
Liquidity is never a cure for solvency, but it postpones it. So it's commercial real estate's going to have to enter this discussion at some point.
We'll come to that, but let me continue that thought too.
But again, he's not preventing the bankruptcies.
Yeah, but that's where I was going to go to. Is that you talk about you just extending the inevitable, right? It's like a bad relationship. You just keep doing it,
right? But you're screwing creditors out of any kind of. I mean, Moody's took the recoveries down on senior lien on first liens to
first lien bank lien,
to I think 50 cents a few days ago.
Yeah. We've always said that probably in this next crisis that the first lien stuff will have significantly lower recoveries than the past. This is the covenants and everything.
Second lien ones might not even
recover at all.
Recover at all.
Right. But you're talking about postponement. Haven't we been doing this not just for 3 months? Haven't we been doing this since 2008? Right? Isn't this been the whole game? You're talking about the confidence game.
Think about Bianco had pre-COVID. Bianco had what 14% zombies.
Yeah.
And now they're 20%.
And the definition of zombies for our listeners?
So you don't make enough money to cover your interest.
Right. We call that insolvent practically, right?
Yes, we do call that insolvent, don't we?
Yeah.
Jay Powell doesn't call it insolvent.
No.
He calls it problematic.
Yeah.
And so he's there, but it's just a matter of postponement. He cannot he can't print jobs, he can't prevent COVID fatalities. He can't print cash flow. We were talking about earnings season. I'm following top line much more closely than I am bottom these days. I mean, you've got dividends being pulled left and right. I mean, cash is a serious issue. Cash flow we're going back to like business school stuff we learned about. We haven't been paying attention to revenues in years.
Yeah.
But it's important now.
Right.
Go ahead.
I
was going to say, before we let you jump into the CRE and what some of the implications are there, I know we had you on the podcast last year.
Uh-oh.
I mean, it was back in May. It's only a year but it seems like more than a lifetime ago now with all that's
You
transpired.
remember when we
but,
were all here in the David Rosenberg and we were all
Yeah, we were
That's
in this
right.
room even.
in this room
right,
That's right.
in a different world. Anyways,
But I think at that time you were fairly optimistic with Powell. So now you fast forward, to July now.
Look,
How are you feeling about it? Did he do enough? Did he do too much?
So in yesterday's premier Valuetainment Economics plug interview with Jeffrey, he reminded me that FDR walked into a calamity on his first day in office. I can't remember what happened though. Shows where my short-term memory is. But Jay Powell had a 4-digit decline in the industrials on day one, February the 4th, 2018.
And he had a bad track record on all his FOMC speech days too, right?
His FOMC speeches blew up.
Yeah.
His first congressional testimony, he said it's not the Fed's job to backstop the stock market. And people are like, who is he?
Yeah.
I'm, personally founded the Jay Powell fan club on Twitter, and I mean that got me more enemies than you can ever. And then I had
We've made up since then.
well, yes, we have, but he can't let move. Move forced his hand. Move forced his hand on Halloween 2018. Period. End. And the thing that scares him the most is when issuance freezes, because he will forever be scarred by 41 days of no junk bond issuance. Forever. I mean, it will be his
That was
legacy.
like was that December of 18? Is that right when that happened? It was like December and early
Halloween,
January. Yeah.
General Electric's debt was downgraded. November the 14th, issuance closed.
Okay.
And it
November
stayed
14th.
closed for 41 days subsequent to that.
Okay.
So you have the Bank of International Settlement. You have all the collateral backing high yield ETFs was trading by appointment only. Redemptions were going through the roof. Spreads were gapping out. International regulators were like, oh, we got a problem here. Move was going haywire. And Jay Powell had to realize that he was just one man.
Yeah. I don't know if all of our listeners know what Move is.
Ah, yes.
Yeah,
Well,
so they know VIX, but I don't think they know Move.
VIX has nothing on Move.
Yeah.
Move is south of 50.
Yeah. Yep.
I mean,
so Move is the volatility index for bonds. That's what I was getting at too.
Yes.
Yeah.
Move
So a
is-
lot of people
yeah.
don't know that, and it's been just there's been no volatility
None.
whatsoever.
Zero.
Right. And so continue your thought though.
So, but what his legacy will be June 2020, when you have bankruptcy filings at the highest level since 2009, and record high yield bond issuance. I mean, you couldn't come up with two stranger bedfellows if you tried, and yet that's what he's accomplished.
And I think the default rate on a trailing basis, I think it's according to Moody's, about 6% now, mid sixes, and
you've
still
got-
set to elevate.
You've got, I mean, again, the credit rating agencies are going 24/7. They can't keep up because every time American Airlines blows out, $2 billion of fresh debt, along with in the same exact press release, we're going to fire 20,000 people and probably go bankrupt.
Yeah.
I mean, it's like hurts, but
Well, when you're
bigger.
pledging is the last thing you have as collateral is your frequent flyer program, which I know we all participate in, right? And it's dear to all of us, and that's why they have it and it pledges collateral.
American was really happy to see me.
Yeah. I'm sure. Oh no, yeah.
They're like,
yeah.
you haven't.
No.
I'm like since February.
I will tell you, they do call me almost every month too, just to
Oh,
check in.
they
Yeah,
just- hi, how are you?
Yeah, exactly.
You're grandfathered in, and I'm
yeah,
like,
make sure your status is protected for
and
the
I'm
next
like, I'm
3
still
years.
petrified to get on under.
I'm not sure if you're going to be in business in 3 years. but-
Non sequitur,
Yeah.
safest places in the world right now.
Yeah. Yeah.
Their
Yeah, you
air-
just traveled
Their
recently,
air,
so-
their air filtration systems are second to none now.
Yeah.
So an airplane is a safe place to be.
Yeah.
And I sprayed down my plane AIRE. I don't know who owns the company. It's a spray. I sprayed the guy sitting next to me.
Yeah.
I sprayed every surface. I sprayed myself. I sprayed the seatbelt. I sprayed the tray table. I sprayed everything.
Well, maybe that's a business to be
COVID
into.
paranoia.
Yeah.
Totally.
That's hilarious. So we were talking about that. Let me just give you another thing we were talking about as our debt team was looking at the American Airlines deal. I mean, I think it was like a 12 coupon or something, and we couldn't get our minds around the risk. But anyway, the joke was, well, what's the next thing they're going to pledge as collateral? Do they have some stale peanuts on the plane, right? Because it's like what's left unencumbered, And I
That
think
would-
given, but I
That
don't know
would be
if you could-
Southwest with the peanuts,
Peanuts,
but they don't
right.
have debt.
Right. So maybe it is the peanuts were already pledged the first time and they were pulled back. So in this peanut allergy world we have. So let's.
But American is just like Wells Fargo, right? Because the next day United said, I'll see your 20,000
Of
and raise
course.
it to 36,000.
Right, and they'll also, and by the way, we're pledging our
Exactly.
frequent flyer
We're
program.
also going to raise debt, and we're also going to declare bankruptcy
Bankruptcy.
in a little while. We'll be back.
Yeah.
This is on top of the bailout money they took out from the initial CARES piece, right?
Yeah, I mean,
think
they're already. They're announcing that on September the 30th, when the bailout strings are cut, they're going to lay off
They're done.
thousands
Yeah.
of people.
Well, they're going to have to. I mean, as you talked about before we jumped on here, they've got crowded planes. There's limited routes, but they've got to try to make money somehow, right? I mean,
My flight landed an hour early
Yeah.
because they're still padding it as if there's like
there's all the traffic.
You're 25th in line for takeoff. No, I mean we backed up, took off, landed.
I did fly 2 weeks ago, and when I flew, we departed the gate 40 minutes early, and we arrived an hour and a half early. So that shows you how they are padded. But also
Well,
remember,
just-
LAX is a very crowded airport most
Right.
days, especially American Airlines.
Right.
They run out of gates.